Generally, a higher credit score will improve your chances of getting approved for a mortgage. Debt-to-income ratio. Your debt-to-income ratio, DTI, is the percentage of your monthly income that goes towards paying off debts. Lenders prefer borrowers with a lower DTI because it suggests that they have a lower risk of defaulting on their loan. Employment history. Lenders will evaluate your employment history to determine whether you have a stable source of income. Generally, lenders prefer borrowers who have been employed for at least 2 years. Down payment. The down payment is the amount of money you'll need to pay up front to purchase a home. Lenders prefer borrowers who can put down a larger down payment because it suggests that they have a lower risk of defaulting on their loan. Tips for getting approved quickly. If you're looking to get approved for a mortgage quickly, there are a few things you can do to improve your chances. Here are some tips. Check your credit score. Before applying for a mortgage, check your credit score to make sure it's accurate. If there are any errors, dispute them with the credit bureaus. Get pre-approved. Getting pre-approved can help you narrow down your home search and make your offer more attractive to sellers. It also shows the lender that you are serious about buying a home. Gather your documentation. Before applying for a mortgage, gather all the necessary documentation, including pay stubs, tax returns, bank statements, and proof of employment. Pay down debt. If you have a high debt-to-income ratio, consider paying down your debt before applying for a mortgage. This will improve your chances of getting approved. Save for a down payment. If you can afford to, save for a larger down payment. This will show the lender that you have a lower. The mortgage approval process can be a complex and time-consuming task, but it's an essential step for anyone looking to purchase a home. In this article, we'll discuss how the mortgage approval process works, including the factors that lenders consider when evaluating a borrower's application. We'll also provide tips on how to get approved for a mortgage quickly and efficiently. Overview of the mortgage approval process. The mortgage approval process involves several stages, including pre-approval, application, underwriting, and closing. Here's a brief overview of each stage. Pre-approval. Before applying for a mortgage, it's a good idea to get pre-approved. This involves meeting with a lender to review your financial situation and determine how much you can afford to borrow. Pre-approval can help you narrow down your home search and make your offer more attractive to sellers. Application. Once you've found a home and are ready to apply for a mortgage, you'll need to complete an application. This will involve providing detailed information about your income, employment, debts, assets, and credit history. Underwriting. After you've submitted your application, it will be reviewed by an underwriter. This is a person who works for the lender and is responsible for evaluating your application and determining whether you meet the lender's criteria for approval. Closing. If your application is approved, you'll move on to the closing stage. This involves signing a lot of paperwork and paying closing costs, including things like appraisal fees, title insurance, and loan origination fees. Factors considered by lenders. When evaluating your mortgage application, lenders will consider a variety of factors to determine whether you're a good candidate for a loan. Here are some of the most important factors. Credit score. Your credit score is a 3-digit number that reflects your creditworthiness. Lenders use your credit score to evaluate your ability to repay debt.